Midweek check-in. Welcome to Modern Investing Techniques, episode 30. I'm Patrick in Vancouver. Today is April 29th, 2026. Midweek, let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Big tech earnings and Powell's final FOMC tomorrow loom as stagflation concerns weigh on private credit and energy supply chains. Markets retreated modestly today with the S&P 500 closing at 7,139, down 0.5%. The NASDAQ Composite finished at 24,664, down 0.9%. The TSX Composite closed at 33,584, down 0.7%. Sentiment is cautious ahead of quarterly results from four of the world's most valuable companies and the Fed's rate decision. The focus is squarely on artificial intelligence revenue growth, cloud performance, and whether rate cuts are now off the table. Our simulated portfolio stands at year-to-date minus 0.52% versus the NASDAQ up 6.15% for an alpha of minus 6.67%. Since inception, that alpha is minus 10.75%. We need a strong week here. This echoes our TMUS relative value rotation from about 15 days ago that captured 0.61% alpha by spotting superior risk-reward in U.S. telecom. With sentiment this fragile, the difference between surviving and thriving comes down to how you triage quality inside challenge sectors, which is exactly what we are covering in today's Strategy Spotlight. Quality triage in challenge sectors means systematically ranking names instead of avoiding the entire sector. The ranking uses leverage below 1.1 times, investment grade status, portfolio scale, mark-to-model realism, and premium to net asset value. This identifies the best of a bad lot when headlines look ugly. Today's conditions make it relevant because current parallels to the 1970s are harder to ignore. Committee debate now centers on admitting rate cuts are off the table. In practice, you screen business development companies using those leverage and rating filters. For example, the largest publicly traded one has a $12.8 billion market cap and a $22 billion investment portfolio. It runs at 1.05 times leverage and ranks highest among 39 names despite 100% private credit exposure. This approach worked best during late 1970s repricing cycles when quality names survived sector-wide markdowns. Higher leverage peers got hit first in those environments. Risks include net asset value lagging reality by 1 to 2 quarters. Accumulated losses can appear only in the second or third quarter reports. The strategy therefore demands strict position sizing and readiness to reduce exposure on any sector-wide liquidity squeeze. The one-line takeaway is quality mitigates but does not eliminate sector headwinds when mark-to-model accounting delays loss recognition. This same discipline of looking past headline prices carries over into how we should think about dividends and special distributions, a lesson many retail investors learn the hard way. Imagine you had been watching STNE around $14 only to see it issue a $2 per share special dividend after selling part of its business. The quoted price dropped to roughly $11 to $12. Many retail investors immediately think they are getting a better entry with a lower break-even point. What actually happens is that on the ex-dividend date, the opening price is mechanically reduced by the dividend amount. All else equal, the prior owner receives the cash while the new buyer purchases the company at its now smaller asset base. Your total economic position is unchanged. In Canadian tax-advantaged accounts like a TFSA, the $2 dividend is received tax-free. Yet the adjusted cost base for capital gains purposes drops by the dividend amount on special distributions. Platforms and quote feeds automatically adjust the displayed price, but they rarely flag the simultaneous change in the company's enterprise value. The biggest misconception is treating the post-dividend lower share price as an automatic bargain, without recalculating valuation multiples on the reduced asset base. Always compare pre- and post-dividend enterprise value over EBITDA or price to sales on the core remaining business. Adjust your TFSA or RRSP position size accordingly. Speaking of disciplined valuation, we have a same-day flash trade today that perfectly demonstrates comparing forward multiples across an entire sector instead of chasing momentum. This is a simulated trade for educational purposes only. No real money is involved, and this is not financial advice. Today's flash trade is EXE, or Expand Energy, on the New York Stock Exchange. It was formed by the Chesapeake Southwestern merger and is now the largest independent United States natural gas producer. The name sits at the cheapest sector multiple of 12.61 times forward earnings. Consensus target is $135 against recent levels around $107. The daily chart shows the stock below longer-term resistance but supported by volume confirmation in energy names. We are using a 5% stop loss on a $1,000 simulated position. The target is between 1% and 4% by tomorrow's close. Confidence is medium because two factors are aligned. Those are the cheapest multiple in the sector and the structural liquefied natural gas tailwind from the merger scale. One uncertainty remains around broader macro repricing timing. This trade demonstrates how to isolate relative valuation and post-merger scale advantages. It trains you to compare forward price to earnings across an entire industry rather than chasing headline momentum. The exercise also shows why verifying the same consensus data across multiple providers is required before committing capital. Before we get to the tools, let us review how yesterday's catalyst-driven flash trade on CLDX played out. We entered CLDX at $35.79 at market open. We exited at $34.38 at market close. That produced a 3.94% loss, or $39.40 on the $1,000 position. Alpha data was unavailable from the primary tracker for the exact holding window. The realized loss still produced negative alpha versus the NASDAQ Composite move over the same period. Despite the publicly confirmed positive catalyst, the stock moved against us because expectations had already been priced in. Sector momentum was missing, which is a pattern we have seen before. This reinforces the critical need for multi-source verification to judge true alpha versus the NASDAQ. The new rule is always verify data availability from multiple providers before declaring a weekly hold closed. The edge we are hunting in these trades often shows up first in unusual options flow and dark pool prints. Which leads us to today's tools and techniques. Unusual Whales surfaces real-time options activity in dark pool prints. It lets individual investors see where institutions are positioning ahead of binary events such as FOMC decisions or earnings releases. The platform quantifies flow size and strike clustering that often precedes price moves by 24 to 48 hours. Canadian users running TFSA portfolios can overlay the flow with TSX listed names or United States ADRs. Access the free tier for basic alerts or subscribe for full order flow visuals and scanner. Stashaway is a Canadian robo-advisor that builds and rebalances exchange-traded fund portfolios according to your risk tolerance. It automatically harvests tax losses inside non-registered accounts while keeping TFSA and RRSP allocations fully invested. This delivers an edge for busy professionals by removing emotional decisions and maintaining global diversification. Fees are competitive with do-it-yourself brokerages, though users note room for better performance reporting and mobile experience. Sign up and run a side-by-side comparison of its model portfolio returns versus your own last 12-month do-it-yourself results. While those platforms help you see institutional positioning, the market itself is sending some clear signals this week. Here are the quick hits. Visa processed $14.2 trillion in transaction volume last year. That is up from $5.7 trillion a decade ago, indicating sustained strength in consumer and business spending. Add V to your TFSA watch list and buy on any 2% pullback to the 20-day moving average. Tomorrow is the most important day of the quarter with big tech earnings after the close, plus the Fed's interest rate decision. Trim 10% of any single tech names exceeding 8% portfolio weight before tomorrow's close to manage event-driven volatility inside your RRSP. GOOGL hit $350, an all-time high. Further gains of roughly $70 per share would push market cap past $5 trillion. If already long GOOGL in your TFSA, set a limit sell order at $355 to lock in partial gains ahead of the print. The TSX moved lower, finishing down more than 100 points. Uncertainty over the Iran situation weighed on sentiment. Pause new Canadian energy exposure this week until the Bank of Canada rate decision clarifies the domestic policy response. And that brings us full circle to the listener challenge that ties today's education and strategy together. Open your brokerage account and pull up one stock you already own that has paid a dividend in the past 12 months. Note the ex-dividend date and the price drop that occurred, then recalculate its current forward price to earnings on the post-dividend asset base. Spend under 10 minutes and you will immediately see whether your cheaper-looking entry was real or illusory. Before we wrap, I have my eye on how the energy sector digests tomorrow's Fed decision and big tech capex guidance. That's your modern investing techniques for today. Every episode makes you a sharper investor. Subscribe, leave a review, and we'll be back tomorrow with more market intelligence. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.